During the past 3 years, an unprecedented car price bubble has emerged, only to be followed by an impending crash of monumental proportions, as predicted by experts. With a surplus of vehicles flooding the market just as consumer demand significantly cools down, the inflated prices cannot be sustained. This holds true for both new and pre-owned cars. The collapse has already commenced. In fact, we have already identified certain models that have experienced substantial price declines in 2023 and have gathered enlightening data and brutally honest forecasts regarding the ongoing auto market crisis. However, before we proceed, we kindly request your support by liking our work and subscribing to our channel, ensuring that you won't miss our upcoming videos. Over the course of 2.5 years, the average prices for new and used cars persistently escalated, with the assistance of dealership markups. The scarcity of semiconductor chips hindered production, while the demand for cars continued to surpass supply, resulting in record-high vehicle prices. Nevertheless, the current situation is vastly dissimilar. The scarcity of microchips has alleviated, prompting automakers to increase production in order to maximize profits and fulfill consumers' demands at long last. At this juncture, it is highly likely that we have surpassed the peak of prices, but the decline we have witnessed thus far pales in comparison to what lies ahead. Wholesale prices are plummeting nationwide, with Mannheim consulting experts estimating a 9% decrease for new models and a staggering 26% drop for used cars. Over time, the sinking wholesale prices will inevitably translate into corresponding reductions in retail prices. The firm highlights that in April, for the first time in 20 months, the average price of a new car fell below the sticker price. Data provided by the firm also demonstrates the unsustainable nature of exorbitantly high prices. Between January 2021 and January 2023, there was a remarkable 52% increase in used car prices, while new car prices rose by nearly 28%. During that same period, the median household income in the U.S. experienced a 13% growth. However, it's important to note that this figure does not account for inflation. When factoring in the average inflation rate of the past 2 years, the actual increase in incomes amounts to only 7.1%. As a result, used car affordability has declined by nearly 40% over the past couple of years, and new cars have become 15% less affordable without considering inflation. In an environment where buyers are being priced out of the market in large numbers, a crash is inevitable. The only question is when it will occur. Analysts have already issued warnings, and we can already observe a significant correction taking place. However, we're being informed that the impending collapse will surpass anything we've witnessed before, surpassing even the auto market crisis of 2008. The easing of supply chain pressures is helping to replenish the inventory, but the situation has shifted from a state of no supply to an overflow of vehicles. Consequently, the values of numerous vehicles are plummeting at a much faster rate than anticipated. A recent UPS report estimates that global car production will exceed sales by 6% this year, resulting in an excess of 5 million vehicles that will require price reductions to be sold from car lots. Yahoo Finance has reported that automakers are already preparing for a price war, with some of them already implementing price cuts. UBS, in a note to clients, warns of a high risk of overproduction and growing pricing pressure due to bullish production schedules. The price war has already commenced in the electric vehicle (EV) sector, and it is expected to expand into the combustion engine segment in the second half of 2023. A notable example of this is Tesla's recent price reductions for its new cars. The Model X has experienced a depreciation of over $14,000, or 23% since the beginning of the year. The downward trend is also affecting the prices of used Tesla Model 3S, with their average price dropping by $11,275, from $51,251 to $39,976, as reported by icars.com. Likewise, in 2022, the average price of a used Infiniti QX80 stood at $52,874. However, 1 year later, the average price for this large Infiniti SUV in the used car market has dropped by nearly $12,000, reaching an average of $41,094 in April. This represents a significant plunge of 22.3%. Nissan's counterpart to the Infiniti QX80, the Armada, has also experienced a substantial price decline this year. While the used version typically cost $41,771 last year, current reports indicate that used versions of Nissan's full-size SUV have an average price of $33,300, marking a 20.3% decrease. Furthermore, used Land Rover Discovery SUVs now carry an average price of $40,841, as reported by researchers. In contrast, a year ago, the average price for a used Discovery was $50,973, resulting in a 19.9% decline thus far. Several other popular models are expected to undergo significant price reductions. For instance, the new Nissan Frontier currently costs around $39,833 and is projected to drop to $27,146 by the end of 2023. The used car market is likely to experience even higher volatility. Researchers anticipate that a 3-year-old Toyota Camry, currently selling for $27,404, will be priced at $16,548 by the end of the year. The same trend applies to popular used SUVs, such as the Jeep Compass, from $25,605 to $15,706. The Honda CR-V, from $30,193 to $19,599. And the Toyota RAV4, from $32,056 to $20,534. Unfortunately, for those who recently purchased these used models, the future outlook does not offer any relief. While the corrections that have occurred thus far are remarkable, it's important to note that used vehicle values have increased by a staggering 88% since 2020. As a result, they should brace themselves for substantial declines in car values in the coming months. Moreover, when consumers drive a newly purchased car out of the dealership, an immediate loss of 10 to 20% of the car's value is typical, further exacerbating the potential losses. The auto market is currently experiencing worrying consequences that are reverberating throughout the industry. The inflated prices in the equity market are rapidly diminishing, leading to price plunges and leaving investors and consumers with reduced funds to spend. The increased strain on disposable income is putting Americans in a challenging situation. While consumers' disposable incomes had increased in 2020 and 2021 due to pandemic-related factors such as debt forbearance, stimulus checks, and enhanced unemployment benefits, many buyers who benefited from these programs are now defaulting on auto loans obtained during that period. According to Barron's, the United States is witnessing a distressing surge in repossessed vehicles. Auto dealers are reporting repossessed vehicles being sent to auctions, with buyers having loan-to-value (LTV) ratios exceeding 130%. Some dealers even cited ratios as high as 140%. LTV represents the loan amount compared to the actual value of the vehicle. In simpler terms, U.S. buyers are defaulting on car loans of $26,000 for vehicles worth only $20,000, resulting in an LTV of 130%. In its recent earnings call, financial services company Wells Fargo also reported a higher loss ratio from auto loans. If the supply continues to increase, driving prices further down, a new Land Rover purchased today at a substantial premium will retain only a fraction of its value in 5 years, as it will have depreciated in line with its original price in a normalized market environment rather than maintaining the exaggerated price at which it was bought. In essence, many people are bound to face significant financial losses. However, government officials claim that there is a silver lining in all of this. They argue that the crash in the car market will help bring the inflation, which they themselves contributed to, under control. They suggest that it will provide a breath of fresh air for consumers. Nevertheless, for those who committed to extended leases with high interest rates, the consequences will be catastrophic. J.P. Morgan recently released a study predicting that average used car prices would reach $21,000 by mid-summer. This forecast is supported by Jonathan Smoke from Cox Automotive. He stated, by mid-year, production should start to stabilize and improve, causing monthly payments to become more attainable as prices come down. Grant Piper, a sales manager at Tom Tinsdale Chrysler Dodge Jeep and Ram, confirms that this is already happening in his area, noting that the drop in prices is sharper than dealers had anticipated. Chris Frey, Senior Manager of Economic and Industry Insights for Cox Automotive, believes that things will continue to decline from here. He stated, "During the financial crisis, we had 16 months of annualized declines averaging 5.8%. That's very consistent with what we're seeing now." According to Pantheon macro chief economist Ian Shepherdson and Goldman Sachs economists, new and used car prices are expected to continue their decline throughout most of 2023. As supply chain concerns subside, automotive prices, which rose at a faster pace than housing, have a significant distance to fall. The car market is entering a severe recession, resulting in sharp declines in sales volumes and car prices, not only in the United States, but globally. The unprecedented 88% surge in car values within just 3 years is indicative of the extraordinary nature of the impending collapse. Asset bubbles, including stocks and housing, are all bursting, and the signs of a car market crash are becoming more apparent. The presence of unpredictable external factors adds to the potential severity of the situation, particularly if we further descend into a recession. Given the circumstances, it is prudent to protect ourselves during this storm and wait for the turmoil to pass. Similar to equity markets, a correction in the U.S. car market is long overdue. At this stage, all we can hope for is an earlier rather than later occurrence of the correction, bringing rationality back to the market and preventing the crisis from escalating into something even more severe in the coming months. Billions of dollars in car values are likely to be wiped out in 2023 and beyond. This represents just the tip of the iceberg, and with an economic downturn looming, the situation could deteriorate